A gift card is a loan. You make it, the store takes it, and the terms are the best any business will ever get. No interest, no due date, and a real chance you never ask for the money back. There is a word for the part you never ask for. Nobody says it at the register. Companies say it to their shareholders once a year in a filing. And last year, at one American coffee company, that word was worth $222.4 million. Here's what actually happens when you buy one. You hand over $25, the store hands you a rectangle. Nothing comes off a shelf. No coffee is poured, no sweater is folded into a bag. You have paid full price for a promise. And on the store's books, that $25 is not a sale. It cannot be. A company only earns revenue when it delivers the thing it promised, and it has not delivered anything. So your money goes into the liability column, filed under what this company owes to other people. It is the store's cash and the store's debt at the same time, which is a strange place for money to sit. It does not sit there forever, because some of those cards are never coming back. One gets spent down to a balance of $5.60, and that stays on it until the end of time. One goes into a coat pocket, and the coat goes to a thrift store. The industry term for that money is breakage, which sounds like something that happens to a plate. It is the accounting word for a promise nobody came back to collect. Keep that word. There is a specific date attached to it. First, the size of the drawer. In a survey from 2024, 43% of American adults said they were sitting on at least one unused gift card, voucher, or store credit, averaging $244 each. Nationally, that is around $27 billion of paid-for, undelivered merchandise. And the reasons are aggressively boring. 24% got a card for a store that was inconvenient. 23% got one for a store they did not like. Nobody is being defrauded here. The whole system rests on the reliable fact that a person will mean to do something and then not. You might assume the law closed this off. It tried. In 2009, Congress made it illegal to sell a gift card that expires in under 5 years, and illegal to charge an inactivity fee until a card has gone unused for 12 straight months. That is real consumer protection. It ended the era of the card that quietly ate itself. Retailers did not appear to mind. Here is Starbucks in its own annual filing describing its cards. They do not have an expiration date. The company charges no service fees that reduce your balance. Take that as a boast because it is one. A company does not need a deadline to collect breakage. It has a drawer, so let us measure the drawer. At the end of its 2025 fiscal year, Starbucks was holding $1,751.7 million in gift card and loyalty balances. Money already paid. Coffee not yet made. Out of that pool in that single year, it recognized $222.4 million of breakage as revenue. $200.4 million through its own stores. $22 million through licensed ones. That is revenue with nothing underneath it. Not a thin margin, not a fat margin. No cost at all. No bean, no cup, no barista, no lid, because the product was never made. That is the entire point of it. But the number has a history, and the history is the strange part. Before 2019, companies booked breakage using something called the remote method. You waited until the chance of a customer ever redeeming had become remote, and only then took the money. And Starbucks did not report it as sales at all. It reported breakage down in interest income, which is an unusually honest place to file it. The company was treating your forgotten balance in its own books as a return on money it was holding. Then a new revenue recognition standard took effect, and Starbucks adopted it in the first quarter of 2019. Under the new rule, a company no longer waits. It estimates upfront what share of its cards will never be redeemed, and books that share steadily as other people spend theirs. Here is what that did on the day it happened. On the 30th of September 2018, Starbucks reported a gift card and loyalty balance of $1,328.6 million. The next day, restated under the new rule, the same balance was $970.6 million. $358 million stopped being a debt overnight. $268 million of it landed directly in retained earnings. Nobody bought a coffee. Nobody redeemed a card. An accounting standard changed, and $333 million walked out of the column marked owed to customers and into the column marked hours. Mark that down. Since that change, the breakage line has done roughly what you would expect. $140.8 million in the first year under the new rule. $222.4 million last year. Add up the 7 years since the standard took effect, and Starbucks has booked $1 billion. $324.2 million of coffee that was paid for and never poured. Set that against the rest of the company. Starbucks earned $2,936.6 million in operating income last year, selling actual coffee made by actual people in actual stores. The breakage line is $222.4 million of it. Roughly one operating dollar in 13 out of the only part of the business with no product, no labor, and no customer. Which brings us to what that pool of money really resembles. Starbucks is holding $1,751.7 million that customers handed over in advance, that it is free to spend, and that costs it nothing to keep. In the middle of last year, 4,494 federally insured banks filed their quarterly reports in the United States. 3,907 of them, 86.9%, held less money from their depositors than Starbucks holds in prepaid customer balances. The median American bank held $307.7 million. The banks pay interest on theirs. There is one place the drawer does not pay, and it is worth being straight about. 5 jurisdictions, Delaware, New Jersey, New York, Georgia, and the District of Columbia, require companies to hand unredeemed balances over to the state as unclaimed property, and New York and Georgia let the company keep none of it. 37 states have no such requirement at all. In most of the country, the forgotten money simply stays where it landed. So here is the shape of the thing. A gift card is the only product in the store that is worth more to the seller when the buyer forgets about it. Nothing was stolen. Nobody was tricked. You bought a promise deliberately for a person you like, and some fraction of the time life happened, and the promise quietly turned into somebody's earnings. Nobody designed it this way either. It works this way because a company noticed a number sitting in a drawer, and an accountant found a rule that let them count it. The card says $25. That is the face value. The ledger says something closer to a probability. And if you want the mirror image of this story, $1 billion the government minted that nobody will spend, sitting in vaults and coins, that one is on the channel.